As I told you in the previous video, topic 3 starts at the end of the accounting cycle. We will focus on two of the main financial statements of businesses, both small and large. Those statements are the balance sheet and the income statement. There are other statements, but these two we will focus on. We do that so that you can see what we are working toward. This is the goal of the accounting cycle. Also, these are the things that the owners would see, the balance sheet and the income statement. In the case of a corporation, a large corporation, this is what would be sent to the stockholders. Stockholders are people who own shares of stock, which means that they are literally owners of the business. So periodically, they deserve to know how the business is going, so they would receive these statements. We will start with the balance sheet. On your screen, you see the balance sheet from last week. This was from one of the problems you had last week. As you know, or should know by now, the balance sheet shows the value of the business or the equity, the owner's equity, or the net worth of the business on a specific date. In this case, the date is, as you see, January 31st, 2018. So we see on the balance sheet the different parts of it that you should know by now. We have on the left side assets. These are things that we own. On the right side of the balance sheet, we see liabilities. These are things that the business owes. And if you take the total assets, in this case, $173,050, subtract from that the total liabilities, what we owe, $60,850. The difference is $112,200. That is the owner's equity or the net worth, and also sometimes this is called the capital of the business. This is what the business is worth on this particular date. Okay, now we're going to add a couple new things to this balance sheet. Let me click on a tab at the bottom. And if you look at this, this is the same balance sheet, but I've added something to it. If you look right here, this is something called accounts receivable. This is an asset. This is something that we own. Accounts receivable would be things or amounts of money that people owe to us. So customers of our business owe us $8,000. Obviously, this means they charge something. They owe us money. So that can be considered as an asset. What's important, two things. One is this is very common in all businesses that one of the assets would be accounts receivable. Secondly, as you see, this would add $8,000 to our total assets. Makes sense. We have a larger amount on this side of the balance sheet than we had before. Liabilities stayed the same. We don't owe any more money. This is the same as in the previous balance sheet. But when you subtract total liabilities from the total assets, the amount is $8,000 higher. So now our business is worth more because people owe us money. Now, if you go back to accounts receivable, in the real world, there may be some accounts that are owed to us, and we own these accounts receivable. We expect people to pay it, but sometimes they don't pay. So what do? Well, we're not quite there yet. We'll talk about that later in the course. But for right now, we will assume that these accounts will be paid for us, or paid to us, I'm sorry, and that is an asset, and in the end, that increases owner's equity. Now, let's go to another example. This is the same thing on the left side. Total assets, including accounts receivable, total $181,050. That's the same. But over on the right side, I've added something called accounts payable. You might guess what this means. The opposite of accounts receivable. So we owe money. So we owe somebody $6,000. So we bought something and we owe money for that. So that's a liability, something that we owe. that would obviously increase our total liabilities. And again, by subtracting this total liabilities from the assets, now owner's equity went down a bit from what it was just a moment ago because we owe more money. A couple things with this. In the liabilities, you see loans, office furniture, loan for paint, loan for computers. Those could be separate if we feel the need to, so that people understand what we owe money for, but they all could be lumped together in one accounts payable. Now that may be a little bit unclear to the owners who see this balance sheet, because they would wonder what are these accounts payable about. So sometimes they're separated out. But for right now, we have some loans that we owe. We also owe a mortgage on the company building, which basically is a loan. So we owe all this money for the business, and then another amount of $6,000 is added to that. So we owe all of that money, which totals $66,850, giving us an owner's equity, or again, net value of $114,200. One more asset I want to add to this. You won't see this on this balance sheet, but in the future, we will be talking about an asset called inventory. So if we own a business that sells something, sells a product, could be a grocery store, could be a hardware store, could be something that sells a product, we would have an asset over here under this listing of something called inventory. These are things that we have on hand. These are things that are on the shelves of our store that we're going to sell. Inventory would be an asset, and we pay for inventory because if we're a grocery store, we don't grow the food, we don't grow the vegetables and the fruit that we sell, but we buy it from somebody. And when we buy that inventory, we owe money for it. So either we pay cash, which means we would reduce the cash that we have, either in our cash register or in our savings account, because we paid for the inventory, or we bought inventory and listed as an asset, and then we charge it, which means we would owe more money. And that would mean the accounts payable over here would go up. So as an example, if we bought inventory of $500, we would add it over here in this asset section. We would have inventory, and we would put $500 right there, which would include, which would increase our total assets. If we bought that inventory and we charged it, our accounts payable would go up because now we owe that $500. That would make accounts payable $6,500, not $6,000. So you can see the effect that it would have on total assets, the effect that it would have on total liabilities, and the effect that there would be, if there's anything, on owner's equity. And we'll have to look at this in a bit more detail, because if you add 500 to assets because you bought inventory, and you add another 500 to liabilities, which means you owe more money, the net effect is zero on our owner's equity. It stays the same. We'll have to talk about that concept a bit more. But these are important aspects of the balance sheet. Now, I want you to go back to your course page, and the assignment for today will ask some further questions about the balance sheet that we just looked at.